Good afternoon and welcome to the Pivot Series organized by the Northern Virginia Economic Development Alliance, NOVA EDA. I'm John Jacobs, your host for this session and for the series overall. Thanks so much for joining us today. This session is about a critical step for anyone considering entrepreneurship, making sure that your idea or startup is investor ready. Before you even try to pitch to investors or anyone else. Whether you're transitioning from federal service, government contracting, or exploring entrepreneurship as your next chapter, today's conversation will give you practical insights from experts who know both sides of the table. A few housekeeping items for you first, if I may. There's a chat button in a chat session, and the session is shared by everyone. So please, everybody, do feel free to engage and jump in there. My experience over the last number of episodes has that folks have really gained a lot from interacting, and certainly the conversation amongst the panelists is more robust as well. So please go ahead and do that. Secondly, Q&A, there is a Q&A button. And so if you have questions for the panelists, try to land your questions there, but if they end up in the chat, we'll most likely see it. We will answer most of the questions as they come along toward the end, however, of the session. However, we'll pick one or two along the way if it's relevant to that topic at that moment. So, you may have that experience going on. We have a great panel for you today. One of our panelists is having some technical difficulties, but we'll get her on board here. And so let me go ahead and make some quick introductions. Anthony Millin is an attorney specializing in startups as well as a former venture partner. Anthony is founder and co-chair of Next, which is the winner of the 2024 Nation's Top Law Firms for Enabling Startup Success. Anthony is also co-founder and CEO of My Next Raise, a technology, community, and education platform that helps founders prepare for and navigate the fundraising process. Dan Woolley is an investor, entrepreneur, and founder of Ponderosa Management Group. Dan was also co-founder of the Mach 37 Cyber Accelerator in Northern Virginia. He's helped launch and advise scores of startups and brings a wealth of experience on both the investor and founder side. Haley Bryant, who will be along, is a partner at Hustle Fund, an early stage venture capital firm known for backing bold ideas and bold founders at the pre-seed and seed stages. Hustle Fund maintains a portfolio spanning fintech, digital health, Web3, and SaaS solutions. Haley brings a pure venture capitalist perspective, answering the question of what are investors looking for and what makes a startup fundable. So I'm going to go and hopefully we'll have Haley shortly, but in the meantime, let me start with a general question. And Dan, Anthony, let me throw it at you first. So I mentioned the word investor ready and words investor ready. What does investor ready mean to you?
So when you're going out to raise money from investors, and there could be a range of investors, there are a range of actions you can take to be what is called investor ready. And this is important regardless of whether you're raising money from angel investors or you're getting ready to go to an accelerator or a seed stage VC, equity crowdfunding. There's corporate venture capitalists, there's revenue-based investors who invest and take based on a revenue share. So regardless of that, you want to make sure you've refined and honed your pitch deck and your pitch and have practiced it many, many times, so that when you're going in front of investors, you're ready for that. You want to make sure that all of your legal foundational documents are correct, executed, and organized. And that's very important. You want to make sure that you have a financial model in place that reflects an understanding of your business model and assumptions and how you generate revenue. You need a cap table that reflects who owns the company. You want to set up a data room to be able to keep all these documents organized and easy to navigate for the investors who are going to do due diligence. You also should know how much you're looking to raise from this different group of investors and what you're going to use the money for. And you should have advisors around you who understand startup space and understand the different types of securities like safes or convertible notes or priced rounds that you'll be using. So all of those are things that are within your control. There's a lot not in your control when you go through a fundraising process. So really being ready for the things that are within your control are what is very important.
Great, great. And there's Haley Bryan, folks. So, so my guess is I probably sent you it was a challenge, Haley, and you succeeded. Congratulations. Well done. Well done.
Thank you for
Uh,
having.
and we made an intro of you and of Dan and Anthony a moment ago. But Dan, so from your perspective, has that covered, what's your view of investor ready? What does that mean?
I mean, I've kind of got a broad view of it, but I think ideally, do you know where you want to go? Do you have an idea of the vision? Is it really clear? And I think probably from my perspective, I ask really a couple of key questions, which is, do you know what your business problem is you're trying to solve? Too many early stage companies launch into this and they have huge visions, but they really can't tell you the business problem they're trying to solve. And as you go through all the things that Anthony defined that you have to have physically ready, the checklist, if you can't clearly define the business problem you're doing and who the potential customers are and how big that pool is, you're not ready. You really got to have that in your mind.
Haley, any additional thoughts?
Yeah, love Anthony's points, clearly outlined what materials to have ready for an investor meeting, and agree completely with Dan. It's about the problem definition and the customer you're trying to support. I really like to think about what is a day in the life of a customer? What's the first thing they turn on, the last thing they turn off? What are they spending money on? What problems are unsolved currently? And why is this the number one most important thing that they need to solve in their business today? So being able to speak really clearly about the customer is very important to us, and being prepared. And I think too, being able to say your piece concisely, right? Do you have your 30-second elevator pitch, which typically includes, because investors at the earliest stages are often only spending 30 seconds looking at a pitch deck. I know your team, your problem, your solution, your traction. And to Dan and Anthony's point, what the ask is, how much you're raising. So being able to communicate that really clearly and concisely is important.
Great. I've been thinking about funding for startups, and next question is why would founders turn to angels or venture capital firms rather than trying to pursue grants or just bootstrap their startup? Dan, what's your perspective?
Yeah, I mean, I'm kind of very specific. If I am coming out of the federal world, well, let me break this in two parts. There are really two worlds that exist. There's a service world and there's a product world. And services are based upon the IP by which consulting groups are built, if you will. Product is built on literally defining and building your IP. When you are in the midst of trying to figure out how much money you're going to go and where you're going to go, you kind of have to figure out what your roadmap and what your runway looks like. If I am going to do services, I probably can do grants, I can probably do funding, I can probably go friends and family because I'm generating new customers with each one that I go after. If what I'm doing is building a product, I have to start thinking about creating a MVP. I have to think about what your first version is, and your lifespan to get there will take you maybe a year. You better find money for that. And it could be a grant, it could be non-dilutive funding, it could be friends and family. And once you start to get that solid, you can kind of make a determination. For people coming out of the federal government, Washington in general has been traditionally a service-based startup community for years. It's only been in the last maybe 10 years that we've evolved to a product company. So people coming out of the federal government could reach out and get money from any number of sources to hang up their shingle, and they could start doing consulting services. Only recently have we started to go down the path to actually build products. And now we're starting to take a look at making sure that we've got venture capital in there that gives us enough runway to get that MVP done. So really it's kind of a determination. Do you want to do services? Do you want to do product? If you have to do product, you better find some way to get money. If If you're doing services, you can probably hang up a shingle and actually start bringing in revenue. Again, it's an individual model.
You know, it makes me, and to Haley and Anthony, just jump in at any time if you have additional points. You know, when I think about we talk about dilutive and non-dilutive investors. Do well, my one question is, do VCs or angels offer more than cash in their relationship? And can you define that and maybe define between angel and VC? So maybe throw it at Haley for a quick sec.
Sure. So thinking about who you want to seek funding from is a key consideration when you're early in building your business. A couple of things I think about, I often have the conversation with founders. Would you rather own, 100% of a $10 million a year business or 10% of a $100 million a year business? Often if you have really big ambitions, you're building something in hardware, in med tech, you want to build, the next OpenAI, you're going to need a lot of capital to spin that up. And often that's going to come from a combination of sources, and venture capitalists and angels are probably part of that conversation. But part of it's also about values alignment and then what you need from the money that you're getting. So I do hope that and Dan can probably speak to this more, and Anthony as well, that you're bringing smart money around you when you're building out your cap table, that you're really thinking about almost hiring the investors that you bring on. So thinking about what are your unique zones of genius, what are the things that only you can do to build your business, but also the things that you're going to need support on. And maybe that's things like hiring, customer introductions, advice on how to scale up your marketing sort of department. So those are things you might seek out from venture capitalists and angel investors. Everyone has a different strategy and focus. We believe at Hustle Fund, where we've built now a community of 2,500 plus angel investors, 50 plus of which are in the DMV. Happy to share more. Angels often work harder than their money might suggest. So they may only give you $1,000, but they're going to roll up their sleeves and talk to you in the middle of the night or on a Sunday when you're stressing about, oh my gosh, what's the next thing I should build in my product roadmap? So don't discount how small their investment is. They can offer a lot of strategic input. Often funds are aligned around a specific, thesis, sector area, so they can provide strategic customer introductions. At Hustle Fund, because we're coming in almost as angel investors, thinking about being the rich aunt or uncle that you may not have. We do think of ourselves more so as angels, and we try to democratize access to capital, knowledge, and networks as a result, because it's the combination of the three that's going to help you accelerate the business, not just a check alone.
To hitch on that for one quick moment, because I think you have to interview your investors as well as the investors in interviewing you. And you know what the weaknesses are in your company that you need to fill. You really want to look at investors as how do they fill those gaps, knowing that your investors are going to move on as you evolve through your life cycle. But get the people that want to come in and want to engage, and you can engage effectively with. Don't get somebody who, is going to tell you everything you need to know and everything you didn't want to know at the wrong time. So you need to interview and make sure that you feel comfortable that the individual is going to either give you access to technology or give you access to money or give you access to customers, but interview them because they are meeting a really significant need.
And I would say in addition, one other point with interviewing investors is you can also interview CEOs of portfolio companies that they've invested in. And this is a long-term relationship when you're bringing an investor on board. It's, as Haley said, you're really bringing a partner into your business, and that partner could be there for 5 years or 7 years or even 10 years. And how that partner is going to react during the different cycles that the company goes through is going to be really important. It's not very few companies just have a straight line up. There's usually, even for companies, when you look at them now and they're unicorns, there were periods of time when it was even questionable whether they were going to survive. And how their investors reacted and stepped in and supported and bridged or or helped other people come in to bridge becomes really important. So not only how the investor is going to be when everything's going great, but also how the investor is going to be as a partner when you're in the rough patches that will invariably come up.
Yeah, and it kind of circles back to John's question about dilutive versus non-dilutive funding. Dilutive funding, which is what VCs and angels are providing, it means you're giving a piece of your company to another person or an institution, and they have a fiduciary duty to either themselves, their families, or their partners that are investing in them to drive the best outcomes relative to their goals at their fund, institution, whatever. So really understanding that, and maybe we can talk more in the conversation about how venture works and what our incentives are to kind of peek behind that curtain and understand the outcomes that we're often going for. So you kind of understand who you're getting into this long-term partnership that Anthony talked about with.
That's great. You know, it does, and again, to the audience, feel free, folks, to ask questions. Well, one question I have of the audience, think about the question, is, have you ever been in a startup audience, and are you considering, like, I'd like to know, raise your hand if you have already got a startup underway, or do you feel like you just have a great idea? So I would love to know that in the chat if you have that. So on that point, Haley, I'm curious about from a venture capital perspective, like what are the typical terms, liabilities, constraints of raising money with a VC or an angel? Because everybody wants to make a return on their investment. Yeah. So
Yes.
maybe Haley, you could hit that first.
Yeah, it's so interesting. I have this conversation a lot with repeat founders who are going back to building for the second time, and they often have a very strong sense of or opinion on whether they want to raise from VCs or they want to bootstrap because they understand the dynamics of getting on the venture capital. So venture capital treadmill. So when a venture capitalist writes you a check, depending on stage, they're expecting a certain multiple on that check to bring back to their portfolio. As VCs, we spend time every few years raising capital from external partners called limited partners, and we have to make the pitch to them that their capital is better spent with us and invested with us than in the S&P 500 or bonds or whatever other asset classes they're interested in. So in general, we're looking for, 4x plus returns on money. For us as pre-seed investors, this means that from whatever valuation we invest at, so let's say it's 5 million post at pre-seed, we need to see a $500 million exit within the 10-year lifetime of the fund. And if we back into that, thinking about the revenue that's needed to generate that kind of exit, it means that in 10 years, you founder are going to get to a 100 million plus run rate so that we can either sell this stake to another investor who's later stage, you're going to be acquired, or maybe you'll have a different sort of exit. So those are kind of the behind the scenes mechanics that we have to believe. So we're often going to push VCs broadly are going to push you to grow really quickly and raise more money. And we do try to be as founder friendly as possible. We don't take board seats, but I think it's helpful to understand those sorts of dynamics. So when we're negotiating terms, going back to John's question, we're thinking about, okay, what do I have to believe to be true to think that there could be 100x exit from this company? And we're thinking about it as sort of a stack ranking exercise with all the other companies we're talking to in a month, right? We see 1,000, we meet with 50 to 100 teams. Like, is this one of the best, say 7 that we've seen this month relative to valuation, market size, growth rate? So then there are these constraints that come into play with the reporting that's required. You need to, be open to external audits every year. You have to send regular updates and keep people in the loop. You may be opening up board seats as you get to later stages of funding, where there are people that you're reporting to that could say, okay, CEO, we don't really like the direction you're taking here. We think you should go this way instead. So again, it is actually luckily a very transparent system. Increasingly, it's a cottage industry that there's been a lot written about by people like Brad Feld. The book Venture Deals is great to read if you're trying to get smart on some of the terms and constraints and VC think behind the scenes, so you don't get played. But we do have these incentives behind the scenes that are important to understand.
Great. Anthony, Dan, you want to contribute any to that?
My perspective has always been, if I'm doing a service-based orientation company going that, I'll look at probably 1.3 to 1.5 forward revenues as my early exit, because you don't see that lift. Also, scaling is an issue. When we start to look at product-based companies, we start looking at anywhere from a 10 to 20% forward revenue. Again, I'm having to look at scaling, I'm looking at market, I'm looking at market opportunity, and I'm looking at most important customer acquisition. And I think when you're in an early stage company, you have to think out. Several years ago, Gartner said in the cybersecurity space, if you can get to $40 million in ARR in 7 years, you're in a really good position to either M&A, go out, go whatever you're going, because that puts you on that track, as Haley said, to 100 million ARR channels. What you have to do is, as an example, is to figure out what the price of your product is. How many of those do you have to sell in a given year to get 40 million, and then back that up? And from an investor, we start to say, do we believe they have a route to market that's actually going to get them there? And is the market big enough to be able to sustain that number of entities? And does the founder have the vision to be able to build that out with the help of the VC teams? Those are all questions that we roll together in the decision base on, are we going to put money in and are we going to get the return we anticipated?
Yeah, Anthony, I have a silly question, so I'll figure I'd ask you because you're a lawyer. And this is going to be a total novice question. Here it comes. Are the relationship with the VC exclusive? Like, would you have 2 VCs or 3 or? Oh,
Yeah, I mean,
Haley
VC.
did not like that question.
No, when you do a round, you often, especially early on, may have a round that will have multiple investors. You'll have one investor or a small group that comes together as a lead, and they taking the biggest responsibility in doing the due diligence. They're negotiating the terms. If it's a round that's big enough for a board seat, and they may be the one who gets a representative on the board. But then you fill the round out with other, you could fill the round out with other investors. And sometimes investors have co-investors they often invest with. They kind of aligned in terms of how they help de-risk companies, how they think about it, how they work to support their companies. So often you'll have a list of investors you'll co-invest with. You may lead and they may follow, or there may be another deal they lead and you follow. It's also helpful, like we said before, when you need follow-on financing or you need a bridge, to have a group of investors who can all kind of chip in and participate in supporting a particular round. So it's not every once in a while you have an investor who'll come in and say, we're going to do the whole round and we don't want to have anybody in it. But a lot of deals get done with a lead investor and then some co-investors.
We used to do a lot of investing, but a lot of the things that we would do, to Andrew's and from Anthony's point, is we do syndication, and that's a term that we use when you start bringing together multiple venture capitalists. Oftentimes it's driven by the size of the raise. I mean, if you're doing 10 million or 5 million, it's probably easy to do it with 1 or maybe 2. But if you get to 50 to 100, 150 million dollars, there's usually a high probability that's going to be syndicated with 2 or 3, and one of those investors will be the lead. And you need to be able to think through that dynamic.
Just changing gears for a sec, our audience typically, overall about 60% are, we surveyed about a month ago, federal employees, 40% government contractors. Everybody essentially looking to pivot this time. Let me throw this, Dan, you're a former Air Force officer, so I'll throw this at you because, that's a federal employee. But, federal workers don't exactly scream startup entrepreneur, right? Because they have this background as, steady employment, low risk from a employability perspective. Obviously, lately things have changed significantly. But what is it? How does one translate from federal service or government contracting to a startup environment? So, Dan, why don't you start off?
I think there are a couple of dimensions to that. We've found in many cases that sales is a 4-letter word. And federal employees oftentimes go, sales? Oh my God, I'm not going to do sales. But they're very good in consulting. They're exceedingly good in talking to the customers. They know contacts, they know the things of that nature. So we have traditionally seen in the non-highly technical spaces, those leaving federal government going into the consulting roles and service roles. For those that are highly technical, and in the cybersecurity space, we used to fund startup founders that were coming out of the NSA. They were coming out of highly technical government areas. We had to teach them about business. And what we find in general is that people coming out of the federal government business, if you will, industry, don't understand the mechanisms that you use to build a business. And it's very challenging. It's very easy for them to make the transition to consulting because a lot of what they do in their day-to-day business is talking and networking. But when all of a sudden you're going into roadmaps and product roadmaps, and there's such a huge difference between a productized technology and a deliverable to a government entity. And if you're coming out of the government, you say, I want this thing to do this thing, okay? And you will build the thing for that item. You have a very difficult time productizing it. Having lived in the software and hardware world, getting to a concept of productization is very difficult. And unless you really understand it, you have a problem. And those coming out of the federal sector oftentimes don't have that foundation. So they need to find technical founders, or as we talked about earlier, when you start to build your circle, your universe, hire the people that are going to fill the gaps.
Mm.
And I think that's an important element.
So something I think is really interesting right now in venture, and maybe Anthony and Dan feel similarly, differently, like would love to discuss. We're seeing so much interest in tech-enabled services or services as a software, which I think a lot of people coming out of the government, to Dan's point, have a unique advantage in delivering this idea of, being forward deployed, this model built out at Palantir to kind of be aware of a customer opportunity, a pain point, and just being willing to talk with them, to do customer discovery, understand their problems, and build alongside them. I think this is actually a really great time to take that approach. And we're seeing this more and more in enterprises in particular who are solving problems that they don't know how to solve because they're new problems that are being created by AI, where this model makes a ton of sense. And we're also seeing, of course, a lot of rebuilding of the service industry because of the margins that AI enables and the new ways of working that it enables. So I think it's just such an exciting time to be coming out of the government and have the skill set that Dan mentioned, and being able to take that consultative approach into all kinds of other businesses.
Yeah.
Anthony, please.
No, I agree 100% with Haley. I think it's a really exciting time in services and the kind of new frontier between what you can do with services, AI, technology, and rethinking of traditional business models that didn't even exist, or the opportunities to disrupt them didn't exist a year ago in the way they do today. And so, that's certainly something, we're seeing in our space, and I think it's available across the board in services. So I think it is an interesting time.
Good hitch onto that, Anthony, is that when we're building companies and building businesses, we really want to look and say, do you know the business problem? We have, and this is not some big problem, this is a specific area with people coming out of the federal service or coming out of the federal environment. They know the problems, and they're able to communicate that very effectively to the big product providers. And the Palantir example is a really good example. When you know somebody who was working in, for example, a SOC, they know what the problems are. And coming out of a security operations center and talking to a Palantir or various technology companies, and bringing that expertise into that environment is extremely valuable. You can't get that oftentimes. And I can't underscore that value proposition. And I think with the government going through as many changes, and it'll probably come back. People who have this expertise, they're going to be needed by other government agencies, if you will, to say, can you come in and help solve this problem? And you can have your own little shingle out there as a consultant, and you can raise money and bring 3 or 4 or 5 people together, and I think build a really nice little business in today's environment.
The I wanted to say to the audience also, from the last episode of this series where we talked about how to build and launch a business, I think the title, and we had the folks from Mason Enterprise on, Paula Sorrell, who runs Mason Enterprise. I'm going to this will make sense in a second. So to Dan's point, if you are a technologist or an engineer from a particular federal agency, perhaps you're not necessarily, you need to find your partners, right? Your commercial colleagues. And some of that could be found at Mason Enterprise and elsewhere, right? They have incubators and they have matching programs. So if you're a double E, electrical engineer, but you don't know the commercial side, I'm sure there's great networking to be had there. I want to just sort of put a plug in for, for our friends at George Mason. Haley, first of all, I would encourage everybody to go to Haley's website, and also to Anthony's, because they're fabulous and what the service and the way that they approach the market. But Haley, before you hear a pitch, or when you hear a pitch, like what signals to you that somebody is prepared well enough for that meeting? Like what's a hit, what's a miss?
Sure. Thank you for the kind plug of our website, hustlefund.vc.
Hustle Fund, yeah.
Check it out. We invest hilariously early, as you'll see on the website. Lots of hippocors on there. In terms of being prepared for a pitch, I think a lot of it is so basic. So don't cut me off. But it's the confidence in running the meeting and not using the deck as a crutch. I think what we often see in very early meetings is kind of just reading the slides, and you spend, 25 of 30 minutes or 50 of 60 minutes just sort of talking through the pitch until your mouth is dry versus trying to approach it as a conversation. And again, this is where I think people coming out of federal agencies have an advantage, because you are so used to navigating politics and talking to people and getting stakeholder buy-in. So the founders that are best prepared often kick off the meeting with that, warm hi. They try to connect the dots quickly. Saw you grew up in Boston and the UK, or you went to this school, or we have a mutual, connection, just kind of break the ice. And then they have questions prepared that show both that they did research on the fund and that they have some sort of strategy in terms of how they're going to fundraise. So these are the things that take you from like 101 to 301 immediately, when you're able to say, I saw that you do a lot of investing in B2B SaaS. What themes are you focused on? Or what are you allergic to? What do you not like to see? So I think some of that is really helpful. And then when you've practiced your pitch enough, and this could be, literally talking into your phone or recording it on Zoom and watching it back, which I know is painful for all of us, but I've done it too. So we can do it together. It could be pitching a founder friend, or, another, someone else who's thinking about starting something, but just practicing it so it doesn't feel like you're, again, like reading off of a deck, because that just makes it feel unnatural. These sound so simple, but because of how early we invest, we're really investing in people. People pivot 30% of the time after we write a check. You may think, oh, this is the customer, this is the problem. But as you get deeper into their workflows, you realize, oh, they said this was the problem. But actually, like, we were going to build for a cost center. Like, let's build for a revenue center instead. This is so much better. So we know things are going to change. So it's really about connection, first and foremost.
I want to hitch on that for a second. When we were doing evaluations for venture, and I'm in the cybersecurity space, there are 2 phases we'll talk about. On average, we would look at between 300 and 400 pitches a month. And we would have to narrow that down very quickly to maybe half a dozen that we may represent back to the rest of the team. And out of that, you'll select maybe 1 or 2 that you're actually going to get serious about. And so you better be really clear. And when you come in to actually have the one-on-one, to your point, Haley, be confident. Don't be a deer in the headlights. Do your homework in advance, and always in the back of your mind, if that meeting gets cut short for whatever reason, know what your takeaway line is. And don't read your slides. And Haley was really good in that. Many years ago, I was a young Air Force officer, and I had to go up to a briefing up in Langley Air Force Base. And there was this poor captain that was up on the screen, and he had the screen, and the whole room was filled full of general officers. And the young captain turned around, and he's reading his slides. And the 4-star walked up behind him and put his arm around him and said, "Okay, son, let's read the slides together. Okay, don't read your slides. Keep your slides tight. Make sure that you only have 2 or 3 bullets per slide. You overload them with information. You want the next meeting. You don't want this meeting. You want to get to the next meeting. And if you are so rattled on trying to get through it, you'll never get to that next round. So get your story straight. Be confident. Know what your team is doing. Keep your story very simple."
And Anthony, let's assume somebody gets to they tell their story, they don't look at those slides too closely, and they get to that next meeting. Like, I'm always curious, how is a startup ready for that next conversation? So we love your idea, right? But how do you know, Anthony, if somebody's really ready or not? And what are their exposures?
I mean, from a legal perspective, we can talk a little bit about how you actually go from an idea to a company. You know, what do you need to do? So, you know, first of all, we talked a little bit today about are you doing this alone, or do you have gaps and blind spots, and the value of having a co-founder, for instance, would be helpful in de-risking even from the very beginning. So one of the first things you do, just if you're sitting with an idea that you believe is a great idea, is kind of determine who do you surround yourself with, from co-founders to advisors, to bring onto the team. Then you actually want to go ahead and you need to actually set up a legal entity. You're not going to be approaching this as an individual, and you need guidance as to whether you're going to do a Delaware C Corp, which is very common if you're going into an accelerator or raising institutional funding, or whether you're starting as a limited liability company and the jurisdiction. So you need to kind of get that entity set up, and you need to get the founders equity in that company that you've just formed. And something else we see a lot is you want, if it's multiple founders, from both the founders protection and the investors protection, you need to set it up where all the shares aren't owned outright on day one. And so you'll set up something called vesting shares or reverse vesting shares. So many times we're approached where life happens and one of the co-founders who owns 50% of the company has to move to a completely different part of the world or a part of the country, or life has changed and they own half the company. And the other partner and co-founder is working 24/7, and the whole cap table is now on its head. And so that's something that's really important. All the intellectual property that you worked on in building up the idea needs to be put into the company. Investors are investing based on the people and the team, like Haley said, but their money is going into the entity, and the IP needs to be sitting in that entity. So that's something else that you want to have in place. And then you want to have any with the intellectual property, whether it's patents or provisional patents or trademarks, to protect your brand name, you need to protect that. And you want to have agreements with everybody who is your consultants and advisors, your vendors. You don't want to not have things documented. That's going to be important. And then finally, when you do want a cap table and a place to start putting your legal documents that you talked about in terms of a data room. So those are some of the things. But most importantly, in that group of advisors that you're surrounding yourself with, having a great startup attorney is an important part of that team from the very beginning. From a financial perspective, you want to have a financial model, a pro forma financial model that shows a deep understanding of your assumptions that are driving the business model. No one's expecting your revenue numbers to match, but they want to understand, the variables that drive the business from a business model perspective. And so those are very, some important first steps to help get started.
Can't underscore getting the corporate entity put in place, because if you ever take money, outside money cannot be given directly to an individual. It must go to the corporation.
Ah,
And you need to make sure that you've got all of those corporate documents in place. But we used to require in Mach 37, we invested in about, I guess it was about 70 some odd companies. We had them to your data box. We put everybody into Carta right out of the barrel. So all of the information and all the legal documents are in one place, because at some point in time, you're going to have to do due diligence. And we know, and I'm going to use your point here, the separation of partners, you have to think ahead to the divorce, and you hate to think about that. But if you don't think ahead, you're going to be in trouble. We were lucky with 70 some companies. We have about 20 that are still alive. We have half a dozen that are over 50 million ARR. We've got a couple that are over 100 million ARR, and we now have one that's about $4 billion in valuation that'll expected to go IPO this next year. You've got to make sure you've got all of your ducks in a row. So it's get those pieces in paper in place early, get your cap tables cleaned up, and be prepared to move ahead.
on that point, again, ignorance question here. How long is the marriage, the birth of VC or an angel? Is, uh, is it, well, you said, so you have to prepare for the divorce, but there's a term, is there a term period?
Well, I would imagine maybe Dan was also talking about the potential that if you have a co-founder, you may part ways at some point.
Yes.
One of the main reasons that startups fail is because of discontent in the co-founder relationship. So it is good to have those pieces in place early, and often the breakups happen early, and that's actually great because you can go on and keep the cap table fairly clean. But for a VC relationship, we generally expect at least 10 years. If you look at private market benchmarks like SpaceX, Stripe, these relationships are lasting a lot longer. It may be 15 plus years. This is not the pitch that LPs want to hear, hoping to get liquidity within a 10-year period. So what's happening increasingly in venture capital is venture capitalists are finding a way to almost pass the baton to the next best investor who focuses on later stage growth capital. But yeah, you hopefully, you still want to talk to this VC even if they're no longer on your cap table. So it's a long-term relationship for sure, and very similar for angels.
And
And
as
I think to that
people,
particular point, what we saw oftentimes was as soon as the numbers, let's say your raise gets to your early raises were like 100,000, 200,000, maybe a million. When you get to a $5 million raise, some of those early enters don't have that big a fund to be able to fund the next round. And you will see them start to move out. You might see secondaries occur. So we used to see 5 and 7 years were about the point where they hit numbers that parts of the early stage venture group are starting to exit because you've made enough money. It's outgrown their fund, and maybe the team is not as robust in the next generation. But once you get over 5 to 10 million, I think to Haley's point, you're going to see those folks they're in for the long run. I mean, they are looking at, you know, big exits. So I think it kind of depends upon where you are and where the fund is and how big the fund is when you start.
Yeah, just a transition here. Anthony, in preparing for this in that prep session, you used the term smart money, dumb money. I'm apparently part of the latter. So could you distinguish like what is smart money, what is dumb money, and from both sides, that is the investor end, is there a dumb money founder?
no, I mean, I think when people are looking at that term, what they're really looking at is, are you getting only money, or are you getting money plus value that is helping you de-risk and grow your business? And especially early on, where there's the most risk, right? With early investors, where like talks about getting involved very, very early on, you want investors like Haley and her team who are very, much more involved in helping you de-risk your business. And that's really what it's all about. You're raising money and you're executing on a next set of milestones. You're taking some of the market risk out, the product market fit risk out, or you're taking some of the technology risk out, or you're building your team up and taking some of the execution risk out, or you're bringing on some additional capital and taking that capital risk out. And when you do that, the business grows in value. And at that next stage, you'll maybe raise another round, but at a higher, at a higher valuation. So we talked a little bit earlier, but I'll touch on some of these again, is having money where somebody has a deep understanding of your market and they know your customer base. If you're looking for those proof of concept customers that you would like to start using your service or product, they can help make introductions. You're looking to add a CFO, or you're looking to add a key person, a chief sales revenue officer, or somebody who's head of sales. They have a great network that can help you add to that team. When you're looking to bring in additional capital in future rounds, they're really good at bringing other capital alongside them. Just execution risk, knowing, when you start a company, you go from sitting to crawling, to walking, to running. And each of those milestones, when you've worked with hundreds of startup companies like Dan and Haley and I have, you get to see patterns. And there are things that become really important decision points that set you down path A versus path B. And having somebody who's an advisor and an investor and guide or smart money to help you think through those decisions. So that all of those are the kinds of things that when you talk about smart money, that's what you're talking about, is this tremendous value above and beyond a dollar is a dollar.
That's great. And there was a question that I just want to answer about, Hustle Fund and Anthony, your websites. So if you could just throw your URLs in there, that would be great. And that every folks can have them. And I do think there's a tremendous amount of information on those sites and ways to interact with folks. So that would be very helpful. So in your point about targeting the right audience. So, and it's funny, I was talking with the folks at Mason Enterprise, they said, well, don't show up to a pitch competition not knowing who's in there. Because if you talk to me about the new version of Legos and you're a SaaS company, I have no idea what you're talking about, right? Haley, how do you vet that? Does that get vetted out really early on for you?
Yeah, in terms of positioning to the right investor audience. So we think about this a lot as VCs because we have to raise capital for our fund, right? So we're often pitching to a combination of institutions, family offices, corporate venture capitalists, and they all have different motivations. So an institution might say, okay, what is my IRR or internal rate of return going to be, right? Because that's how they're incentivized, that's how they get paid, that's how they get to keep their job. They're very numbers driven. A corporate venture capitalist might say, ooh, we're really interested in AI. Can you help us stay at the bleeding edge of AI? So it's a bit more strategic conversation. Whereas a family office, which is kind of akin to an angel, might say, when I was building my company, no one was there to support me because I'm from this geography, or I went to this school, or no one gets my business. So I want to support more founders like that. So if you are having a conversation and you're not just leaning on the pitch deck as a crutch, you're understanding someone's motivations really early in the conversation. And you can gear the conversation around either a more logos bend, which is focused on logic, or a more pathos bend, which is more focused on empathy. And you're always going to have some combination of both, right? It's not just, here are the numbers, write me a check. You're going to bring in more story. You're going to talk through those 5 key points, your team, problem, solution, market traction, but understanding how that person is motivated and why they might be interested in investing will help you kind of tailor how you pitch to each audience. And, ideally, you can't always know when you're at a pitch event, unfortunately, who exactly is in the audience. But sometimes question answer can help, right? Like try to ask a question that brings everyone in the room together. If you want them to think about it from more of an individual perspective versus as like institutional investors. And I do think that often for in-person pitches, the almost Shark Tank format of storytelling works better than here are the numbers, because when you get into the question section, like ideally you've done almost the like top of funnel, let's say, brand marketing to get people excited enough about your story and the opportunity in the market to want to dig more into the business model and why it could be huge. And so those questions can come, but you lead with the thing that, is going to make people feel goosebumps and get excited and see the opportunity and see why it's you and why now is the time to invest.
So to the audience,
I've,
please go ahead. I just
go
want
ahead.
to quickly
And
say,
please disagree, like would love other
Oh,
perspectives.
no, I actually agree, because one of the things we always did with our early stage startups was tell me the Red Riding Hood story. I'm Red Riding. I got to get to my grandma's house and I got to get the food. Let me tell you about how we're going to get there. And
Yes,
people go, oh, yeah, I got it. I'm buying into it.
I love
And
that.
if you can get, we also use the concept of little doggy in the back window. If you can get people's head bobbing in the beginning and they're excited, they will follow you all the way to the end. But if that head stops, you're dead. So when we go to a pitch event, give me a story that will catch them and give them all the way to the end. And you're going to say, this is a really big problem. You agree? Yep. And we're going to solve it this way. Yep. And if we do it right, we're going to be able to do this. And we're going to generate all this money. In the end, we're going to defeat the big bad wolf, and we're going to get grandma her food. So get them a story, tell them the story all the way through, and stay highly focused.
And I
And
think
that's a pitch event. In looking at, and just quick, I'll quickly divert off of this. When you are looking for your venture capitalists, do your homework. I mean, just in this area, we used to have about 160 venture capitalists within the greater Washington metropolitan area. You can identify who's doing what in AI and who's doing stuff in quantum and who's doing stuff in cyber and who's doing stuff in manufacturing. Know those players and target those whenever possible that
yeah,
match your business.
the one thing I would also add, just in these pitches and in these meetings, that is important to come through is passion in what building a startup company is really challenging. It's incredibly exciting and rewarding, but it takes tremendous determination, tremendous passion for what you're doing in terms of the problem you're solving, why you're solving it, why you work 24/7, 7 days a week through ups and downs to keep going. When that passion for what you're doing can come through, that above and beyond just what you're presenting, but kind of why you're presenting it, and why you and why now, and why, that's where that intangible piece comes in. That's really, really helpful.
let me ask you, we're running a little close to time. Folks, if you have questions, go ahead and lay them in there. Normally, if you get them in, this is your chance. You got, 4 minutes thereabouts. But is pitching also an iterative process? Does one get better at it? So, if somebody goes to a VC and you guys are like, oh my God, first off, I love the passion, but boy, oh boy, what do? Do you send him, kick him in, and you send him home? How do you work on that? Maybe Haley first.
Sure. So we know that early on your pitch deck slides probably suck, and we actually have a video on YouTube that has that as the title. So it's like a proven thing, empirically. We are very open to working with founders, assuming that they have a unique idea, they're building in a big market, they have the passion that Anthony just spoke about, and really the hustle that comes from that passion, right? The ability to execute with high velocity and move faster than competitors to win the market. So we know that pitch decks are not going to be great. We want to believe that a founder has really high learning agility and that they're open to being coached to improve. So what we look for is not perfection on day one or anywhere near. It's more so, are they progressing over time? So we'll often go back and forth 20 plus times on a deck, and we want to see that there's the tenacity to stay in it and make the changes and experiment with different narrative flows. So a lot of it is just being open to that iterative process that John's talking about, because it's not going to be perfect on day one, and that's part of the joy of the journey, seeing the story develop and then getting to a point where it's like, oh my gosh, this is so obvious, right? And then you can bring lots more investors in, and you can IPO. You're welcome.
I see it as also every time you pitch is a learning opportunity. And you going to very seldomly do you just give one pitch and get investment dollars. So every time you finish a pitch, you should be coming back and kind of deconstructing the conversation and seeing what questions were asked that maybe you didn't cover in the initial pitch, and updating and learning and iterating and improving for the next and refining for the next one. And so everyone is just an opportunity to improve and get more refined and focused. And that's why it's a process, because sometimes you're going to give 100 pitches or much more than that around before you close your round.
You may kiss 200 frogs before you find the prince. We used to use a model where we said 12 slides, not more than 12. You may have 300 in backup. To get down to those 12 is really hard. And we used to tell the startup guys, they would pitch it over and over and over to us. And as we got ready to go out to the active investors, we do murder boards where we would ask them every nasty question and get them down to an incredibly fine-tuned piece that they could divert from and never have to look at their slide. So again, we used about a 12 to 15 week window in our prep, and each week was a slide. And they may have a whole bunch in backup, but the key is you got to be really quick. You got to keep sharp. We worked, and I'll use this as kind of a sad endpoint here. We worked very closely with NBC News a lot, and one of their senior people, we asked one day, we said, how long is an average news story? And she looked at us and said, it's usually about 60 to 90 seconds. And we said, okay, got that. How long is a soundbite? She said, usually about 3 seconds. 5 seconds, questionable. Anything greater than about 5 seconds, we'll cut it off and we'll edit it. So we got to the point with our startups that each major point had to be able to be covered in 3 seconds or less. The reason they did Mach 37, we launched the next generation of cybersecurity companies. How did you do that? We held a 90-day accelerator, and you could, each point was 3 seconds, because you knew that's all the attention span that anybody had. And if you're in with a VC, 3 seconds, and you can always elaborate, but if you don't get it 3 seconds, you're dead. 12 slides, 3 seconds, and off from there.
That's great. I know we're out of time here, but there was a question I just wanted to sort of see if if you don't mind going over a minute, folks. Question is, what makes a founder or startup mission unforgettable? Is it the solution or the purpose, and how you balance that to stay memorable? So what makes and actually that does tie to the question I was going to ask. So what's a startup mission, an unforgettable founder or mission? You say it's the passion, Anthony, but is it also clarity? Is it a well-worn path and less risk?
I think for a mission to be unforgettable, it's a combination. Without passion, it's hard to, if you're investing in a person, it's hard to know that they're going to be able to stick in it for the long run. I think people have to do something that is very meaningful to them, and what's unforgettable to one investor may be slightly different to what's unforgettable to another, which is why picking the right investors to be in front of based on the problem you're solving for becomes really important as well, because different investors are looking for different things. So I don't think it's a single element. I think it's a combination of a lot of what we spoke about today.
Haley, Dan, anything you want to add here? We're kind of at the time limit here, but I think that kind of gets us there. Dan?
Yeah, I'll jump in. I mean, the thing that's most memorable to me, and I think it has to do with my little company that started with a $50,000 investment that is now over $4 billion in valuation. Vision, passion, and vision. They knew there was a problem. They knew it was a big problem. They set out to solve that problem. They figured out how to get that thing to market. And now they've got, I mean, they're approaching 300 million ARR, approaching 500 million probably another year. Vision. And you talk to the CEO and his team today, and they are as passionate as they were 10 years ago when we gave them their first investment. It took them 10 years to get here. It's that vision and it's that dedication and the unwavering passion to solve the problem. That gets me excited.
And you don't always know what the exact problem is, right? The example I shared in the chat, Tara Vishwanathan, who's the founder of Rupa Health, her mom was sick, nothing was working, even though her dad was a doctor. Tara happened to be in town, ordered some lab tests, and realized it was functional medicine that would help make her mom better. So she tried a bunch of different approaches, realized none of them were going to work, and then ended up building something to serve businesses to make it easier for them to offer these tests to all of their patients. Scaled that, sold it to Fullscript last year, but it did start with that passion, that vision, and just that doggedness, right? The hustle to just keep getting it done and work until she could find the right product market fit to scale. So, John, thank you so much for having us. This has been
Thank
so
you
much fun.
guys. Yeah, awesome. Thanks, audience.
Great.
Thanks,
It was
panelists.
great.
So this episode will be on the Pivot Series YouTube channel. Let's just say tomorrow morning, and on the Nova EDA landing page at novaeda.org. Thanks, everybody. Have a great rest of your day.
Thank you so much.
Take care.
Thank
Bye.
you. Bye.